Were you wondering how some turn pennies into millions? Everyone has heard of investing, but few understand the true power of small steps. Every dollar that stays in the savings account misses opportunities to grow. Did you know that starting small can lead to unimaginable results? The key lies in consistency and knowledge. With every market move, there is a chance to win or lose. But how can you ensure you're on the winning side? Think about how your life would change with a well-defined strategy. Diversification isn't just a buzzword, it's a survival tactic. What about compound interest? They are the magic that turns patience into prosperity. Controlling emotions and making smart decisions makes all the difference. Want to know how big investors master their choices? Which assets to choose and how to plan for the future are crucial questions. What would you do if you knew you could reach your financial goals sooner than you think? Every decision, every step, can bring you closer to financial freedom. And we're not talking about luck, but strategy and knowledge. 1. The power of consistent investing. How small steps lead to big results. Investing consistently is like planting a tree. At first, it may seem like the small amounts won't make a difference. However, over time, these small investments grow into a robust forest. The concept of consistency in investments is simple yet powerful. Small regular contributions, made over many years, can add up to a considerable amount, thanks to the cumulative effect of returns. To illustrate this, imagine investing $100 per month in a stock index fund that historically returns 7% per year. In the first year, your investment may seem small, but as compound interest kicks in, the gains pile up. Over the course of 30 years, this simple act of investing $100 monthly can add up to more than $120,000. This is the power of time and consistency, turning a small initial effort into a big future reward. In addition, the discipline of investing regularly helps to create good financial habits. By automating your investments, you remove the temptation to spend that money on other things. This habit of saving and investing not only builds wealth, but also teaches patience and long-term vision, which are essential for financial success. Over time, this consistent approach reinforces the idea that anyone can accumulate wealth, regardless of their initial circumstances. 2. Diversification. Don't put all your eggs in one basket. Diversification is one of the most important strategies in the investment world. Imagine you're carrying a basket full of eggs. If you trip and drop that basket, all the eggs can break. But if you distribute the eggs in multiple baskets, the drop of one won't do as much damage. Similarly, diversifying your investments helps minimize the risks associated with any particular asset. Investing in different types of assets, such as stocks, bonds, real estate, and commodities, can protect your portfolio against market volatilities. For example, while the stock market may be down, the real estate market or bonds may be up, balancing out your losses and gains. This strategic distribution reduces the likelihood of an adverse event affecting all of your investments at the same time, keeping your portfolio more stable. In addition, diversification allows you to take advantage of different opportunities for growth. Different sectors of the economy and types of assets tend to perform better at different times. By having a variety of investments, you can capture gains in areas that are thriving, even when other parts of the market are stagnant. Not only does this improve your return potential, but it also helps to soften the negative impacts of adverse economic cycles. 3. The impact of compound interest. An investor's best friend. Compound interest is often called the eighth wonder of the world for good reason. They allow your investments to grow exponentially over time. When you reinvest your earnings, those earnings start to generate even more earnings. It's a virtuous cycle that can turn small investments into large sums of money. This is one of the most powerful tools investors have at their disposal. Imagine you invest $1,000 with a 10% annual return. In the first year, you earn $100, for a total of $1,100. In the second year, you earn 10% on $1,100, resulting in $110. This process continues, with your earnings increasing each year. After 20 years, your initial investment of $1,000 would have grown to over $6,700. This demonstrates how compound interest can multiply your money impressively over time. To maximize the benefits of compound interest, time is a crucial factor. The sooner you start investing, the more time your money will have to grow. Even modest investments made early in life can result in large sums in the future. This principle underlines the importance of starting to invest as soon as possible, regardless of the initial amount. Time is an investor's best friend, and compound interest is the tool that makes that time work in your favor. 4. The psychology of the investor. Controlling emotions to make smart decisions. Investing is not just a matter of numbers, it's also a matter of psychology. Our emotions can significantly influence our investment decisions, often in detrimental ways. Fear and greed are the two main enemies of the investor. During periods of market volatility, it is common for investors to panic and sell their assets low, or become overly optimistic and buy high, driven by greed. To be a successful investor, it's crucial to learn how to control these emotions. Establishing a clear investment plan and sticking to it, regardless of market fluctuations, can help maintain discipline. It is also important to set realistic financial goals and timelines for achieving them. This provides a solid guideline that can help prevent impulsive decisions based on temporary feelings. Additionally, techniques such as diversification and asset allocation can help reduce emotional stress. By spreading your investments across different asset classes and sectors, you can feel more secure knowing that you're not betting everything on a single area. This balanced approach not only protects your portfolio from large losses, but also helps you stay calm during the inevitable market swings. Maintaining a rational and disciplined mindset is critical for long-term success. 5. Choosing the right assets. How to analyze stocks, funds, and other investments. Choosing the right assets to invest in may seem like a daunting task for beginners, but with the proper knowledge, it becomes a valuable skill. The first step is to understand the different types of assets available, such as stocks, bonds, mutual funds, and real estate. Each type of asset has its own characteristics, risks, and potential returns. Understanding these differences is crucial for making informed decisions. When analyzing stocks, for example, it's important to look at the company's fundamentals. This includes its financial health, historical performance, and growth prospects. Tools such as financial reporting, market analysis, and price-to-earnings ratios, P/E ratio, can provide valuable insights. For mutual funds and ETFs, examine the fund's performance history, associated fees, and the fund manager's investment strategy. Detailed research can help identify promising opportunities and avoid risky investments. Additionally, it is critical to consider your risk profile and financial goals when choosing assets. A young investor may benefit from greater exposure to growth stocks, while someone closer to retirement may prefer the stability of bonds. Aligning your investment choices with your risk tolerance and long-term goals is essential for building a portfolio that supports your future financial needs. Making informed and strategic decisions is key to success in the investment world. 6. Planning for the future. Setting long-term goals and strategies. Long-term financial planning is the cornerstone of a successful investment strategy. Without a clear plan, it's easy to get sidetracked and make impulsive decisions. The first step is to set specific financial goals, such as buying a home, educating your children, or retiring. Clear goals provide a focus that can guide your investment decisions and keep you on track. Once you have established your goals, the next step is to develop a strategy for achieving them. This involves determining how much money you will need, how much time you have to achieve your goals, and what types of investments are best suited for you. Tools such as retirement calculators and financial advisors can be extremely helpful in this process. A well-planned strategy considers both wealth growth and risk protection. Additionally, it is important to review and adjust your investment plan regularly. Life and market conditions change, and your plan should be flexible enough to adapt to those changes. Periodic reviews help ensure you're on the right track and allow you to make adjustments as needed. With a solid and flexible investment plan, you will be well positioned to achieve your long-term financial goals and ensure a secure financial future. Look to the future and visualize where your investments can take you. Every step taken today shapes a more prosperous tomorrow. Are you ready to turn your potential into reality? The strategies we've discussed are just the beginning. An investor's journey is continuous, full of opportunities and challenges. And this is where the real adventure begins. Reflect on the power of compound interest and how it can multiply your money over the years. Have you ever thought about the impact that some smart decisions can have on your financial life? What will your portfolio look like 5, 10 years from now? The key is action. Every day is a new chance to learn, adjust, and grow. So what's your next move? Understanding investor psychology and mastering their emotions can be the difference between success and failure. Are you ready to take on the market with confidence? Remember, true wealth is not just in money, but in the freedom it provides. And that freedom starts now, with the decisions you make today.